Hello, everybody, and first of all, apologies that it's been so long since the last episode, but welcome to my update for the first quarter of the year of my investment portfolio. So, I don't know if I mentioned in the last episode, which was probably about the best part of 2 months ago now, I did get a new job, and starting that new job, it was a lot more work than what I thought, and it's meant that I've taken a bit of time away from making videos, and also I've neglected my portfolio a bit, apart from a few little changes. So today we're going to talk through what my portfolio is looking like, what my plans are for the future, and things I've learned in the first sort of 3 months of this year. So let's get started. Now, at the beginning of the year, I was sort of going against what the basics of investing was. So I was buying into the hype companies. I was deciding that I wanted to get into all these stocks which are going up crazy numbers, and I basically wanted to make money quick, which is red flags all over the place for investing. When something's too good to be true, normally it is, unless you look at some of the crypto markets which have just gone ballistic. But the way I want to create this portfolio is to be a solid, sustainable form of income, and the companies I'm investing in were just not good for that. Now, one of those is this company here, Neo. It was one of the companies I made an episode on in one of the earlier episodes I made, and it tanked in the 3 months in which I bought it. I bought it at basically the peak, which will be a bit of a theme really for these stocks I'll go through, and it's not really recovered. Now I'm in a bit of a dilemma really, of do I sort of cut my losses with these companies and go back to what I should have been doing to start with, and that was investing in the solid, sustainable companies which had a track record of performing, and go back to that? Or do I hold on until we at least hit a point where we've recovered most of the investments I put into the company, and then pull out and then go again? But that is something which, over the next couple of weeks, depending on how it performs, I'll look at. So along with that, first what we'll do, we'll go through all these companies where I've sort of bought into the hype, and the investments I've gone into for the first 3 months, which really have been more bad choices and have been wrong of me to go into. And then we'll go through sort of the companies which have performed and have done really well for the past 3 months in my portfolio. So the next one, Blackberry. Now, out of all the companies which I've sort of bigged up, Blackberry has pretty much been the number one. Now, we're averaging Blackberry at roughly just under $13. So we're a fair bit down on Blackberry at the minute. But Blackberry's the one out of all these companies we'll go through which I really do see the potential in. I do think it will hit where I want to. It will be the software of choice going forward. So I do think with Blackberry we will hold on. At the minute we're a third down of where we were anyway, so I'm not going to sell it that much of a loss. I'm just going to hold on to Blackberry. We'll stay long. And once we hit a point where I think it's comfortable to sort of cash that out and move it into something else, that's what I'll do. And that's why I say in every video, I'm not a financial expert. I do not give out financial advice. This is just my experience, and I'm hoping that lessons that I'm learning by looking at the big red mark here, saying I've lost so much, will be lessons for you guys. And it will help you guys understand or learn from my mistakes here that investing in the hype companies during the whole meme and Wall Street bet debacle is not the way forward. In my opinion, I think sticking to the reliable dividend companies is the best way to grow your wealth. You grow your wealth over time, and just by being consistent in depositing money and building up your portfolio in your stock shares. So the next company, Ehang, this one went well as well. As you can see, I didn't quite buy into the absolute peak. I really should have sold when it went on that big bull run, and I should have really had alarm bells when it dropped so much in bounce. I should have got out then. I held on, and we're 60% down. Now, luckily I only bought one share. It's not that much of a big deal, but again, it's just something where I bought into the hype of this new fancy stock, and all the meme threads are saying it will be the next big thing, and it really wasn't. We've gone over Neo. One thing I did buy, but this is a bit different from the rest. Now, I did purchase Rolls-Royce. Now, Rolls-Royce is one of the biggest UK companies. It produces not only the high-end cars, but it also has a big contribution to the aviation industry. It produces engines for airplanes. Now, obviously, that's took the biggest hit possible during this pandemic. Not only is it not selling the volumes of cars it normally sells, but the aviation industry has just been battered by the whole pandemic. And because of that, Rolls-Royce really has, over the past year, crumpled in terms of the price. And the price I saw it at, I thought it was cheap for the kind of company I was buying. Now, they don't give you a dividend, so it is purely a growth company. However, I do think this is a lot better of a buy than any of the other things I've done. Will I be saying that in a couple of months when it's gone even further down and I've lost more money? Maybe, but I suppose that's a reason to tune in and see me make a fool of myself. And I will be definitely quoting this in 6 months, whether Rolls-Royce goes up or down, as to whether I was right or wrong. But to me, that looks like a cheap price for that company and the pure capabilities of what it can produce. So that's why I invested. It's the lowest it's ever been, and I think there's companies like this, and also in the cruise line business, where I just can't see them going any lower. There's just potential for that company to explode once the gates open again, and we can go back to doing things we should have been doing, and going from there. Then two other companies, Sensasonics, which was due with the diabetics, and the diabetics insulin. I think again I should have been a bit more careful in sort of keeping an eye on the price, and that's why I don't like these new companies. They are so volatile, whereas all these sort of top tier companies will just keep performing. Even if they do go down, they've got the business model involved to just keep bouncing back and just keep growing. These are newer companies with risky sort of volatile markets, which I really shouldn't have got involved in, and I should have sort of listened to what the basics of investing, and I didn't. So we're down on that. We're down 43% on that one, and Sophie as well. We're down a total of 34%, which, yeah, it's not good. Bought at the peak, bit of a theme, and it went down. So it is what it is, and you learn from it, and that's all this is. This was a big learning experience that if I'm going to sort of try and push and utilize my money better than a bank and just keeping it there with no interest, I need to teach myself better, and I need to make more informed and more thought out decisions than what I was. I was basically just jumping on the hype. I was hearing and reading things on Wall Street bets and other things that these were the companies and these were the companies to sort of invest in, and I followed rather than do my own research, pick reliable companies, and pick these companies which are looking to be a deal. Now, one place along with Rolls-Royce where I have put my money and I am not sort of worried about it at all is AT&T. Now, the reason I bought this is because it has a low PE ratio. It did look like a very good buy at the time being. It is trading near one of its lowest points ever, and I just see it as the right sort of company for me to invest in. It pays an amazing dividend, a really, really good dividend at 7.3%, and the hierarchy in AT&T at the minute, where it has faltered in the past and not been where it should be, have made it very clear that their goal for the future is to pay down their debt, push their streaming service, which does seem to be the way of a lot of these big companies like the Apples and the Netflix of the world, and just continue growth. And because of that, that's why I put a sizable chunk of my new portfolio in, and hopefully we'll catch up with the other stocks I've got in my shares as well to this sort of level. But I think for the time being, this will probably be my lead share once it sort of outpaces Blackberry. And I'm not worried about this. Again, I'll end up quoting myself for this in a couple months' time. But I'm very happy with it. Very happy. And just some companies which have done really well over the past couple of months is Aviva. Aviva is an insurance company in the UK, and we've bought quite well here, and we're sort of 30% up. We'll keep him sort of topping up our investments along with all the other companies, buying consistently, and you'll average out a very good price. And that will be the plan going forward. Bank of America has also seen a bit of a resurgence lately, and we bought in quite well with this as well. Not quite as low as I'd like, but that's just life. But it's going really well with Bank of America. Coca-Cola is still the ultimate dividend. It's just consistent. It's never faltered. I'll just keep building up my shares in that. Easyjet is the UK stock, and it's an airline for the UK, a bit of on the cheaper end in terms of an airline. And I would like to increase my shares in this because I think once
travel is available and people can leave on holidays, I think the travel industry will just go ballistic. It's more so, I just think it will be a very good place to sort of invest for the future. Same with cruises. I think cruises have got a long more way to go than sort of aviation and travel. Along with the Royal Mail, have achieved very good sort of bumps up in the past 3 months, and that is because of people ordering packages. I think distribution and e-commerce and all these things now are pointing to sort of online shopping. It will just be the way forward, and it's just companies like that are just producing fantastic profits in a minute. And I think it's just got such a sustainable model for the future, and things like Amazon as well. It is really good for the future. Dutch Shell, along with Total, I am part of the construction industry, and these two bitumen suppliers or oil sellers or oil refiners are such an integral part. I believe they'll be part of the future, and Shell and Total have got green commitments as well, which means that it will be pushing for future technologies and to make sure they're still relevant in a couple of years, whereas just all relying on petrol and oil. And finally, St. James's Place is the investment company I actually use. It was my first sort of step into investment and set me up with my own pension and stuff like that. And I thought it was quite cool where I could just own the stock. Well, the last few companies, Starbucks, which has done really well. Target, again, just a consistent business model, although it is very pricey at the minute, similar with Starbucks. Everything seems to be a bit pricey, but that's another video. And then the final few things, the Vanguard Funds, which are doing really well. Emerging markets, down a little bit, but I think that's more long-term play. But the Vanguard Funds, I'm really glad I've got them in my portfolio, just because they offer a sort of steady platform as well. Walt Disney, it's expensive in a minute compared to where we've sort of bought in, but I think the streaming service has exploded and has been a lot more successful than anyone would have given it credit for or believed it would have been to start with. So that will be somewhere where we'll distribute the money going forward. Now, I will have a video soon to sort of start trimming down my portfolio. I know I've mentioned I'll do it for a while, and I will. I just think I've got too many stocks, and I want to just keep the list of stocks I'm investing in minimal, proper stocks, and just keep growing them and just showing what it's performing over time. And not only that, I will have another video to show my other investments. I do have a bit in crypto, and just talk about where else I'd like to put my money in the future, just to increase stream revenues and just have my money sort of spread around to be as diverse as possible. But that has been pretty much all the stocks. The allocation now, if you see my pie, admittedly a lot of it is AT&T, Blackberry and Rolls-Royce. Now Rolls-Royce will sort of stay there, AT&T will stay there, and hopefully Blackberry can perform by the end of the year, and depending on how it's looking, we will hopefully either sell or keep it, depending on where we're looking at. But for the rest, these stocks here are what I want to increase for the future. I want to put more money in them, and we're going to continue going with about £200 a week and just slowly keep building up the portfolio to where we need to as well. Over the past couple of weeks, during my time not being able to make videos, I've got quite a few dividends come through, and it's just sort of really pushed the fact that it is sort of the best way to go for the future as well. But hope you've enjoyed. If there's any sort of things you want to point out which is wrong in my portfolio, or any sort of companies which are performing better than what I already have in the portfolio, or just anything you want me to research and just sort of back up of what I've said in the video, by all means leave a comment and I'll always try my best to reply. Hope you enjoy, guys. We'll see you in the next video. Thank you.